Hi, welcome back to my channel. So today's episode number 3, we'll be talking about stock investing slash like a thrift savings plan, 401k, IRA, brokerage account, how I invest money within the stocks. Disclaimer, I'm not a personal financial advisor and I'm not a certified accountant as well. Whatever content here will be just my personal experiences. So I read some books, right, financial books. I took some, online courses when it comes to like investing. Also, I just like to kind of like, do my own research. Again, you can just use this free knowledge to your advantage, okay? First of all, so the difference between stocks and bonds, right, is that when you invest your money in a like a share of stock, you own a share of the company, right? So it depends on how well the company performs, right? You could make 10%, 20%, 50%, or even 100% return on your investment. But if the company is not doing well, they are also going to lose money. There is this thing called volatility. For bonds, you lend the money to either the government or company, right? So they pay you back interest. It's basically like a CD, right? So you buy CDs, like maybe a 1%, 2% return. And when it comes to bonds, maybe like 3%, 4%, just a little bit better than the inflation rate. So when you're young, right, it's always good to take on some risks. I would say take some calculated risks. When you invest in stocks, like it goes up like this, right? There's like ups and downs, but like overall, the stock market for the past 100 years, right, 1920 to like 2020, that's about like on average, that's about 8% return, S&P 500 index. So I'm just gonna go off when it comes to investing in stocks, right? I don't do individual stocks, right? I often buy the S&P 500, the top 500 companies in the United States, right? And also like small cap stocks, right? Which is like the smaller company, right? Like below the top 500 companies, right? So basically I invest in the total stock market. My strategy is to diversify, basically to buy the whole stock market and just kind of hold on to it, right? Just let the return compound itself. That's my strategy, right? And when it comes to TSP, right, you have like two types. So first one is the traditional TSP. It is a pre-tax contribution, right? So basically, if you're E6, you make $50,000 for the year, and then if you let's say if you do like 10% contribution for the year, right? So they take away $5,000. For traditional TSP, right? You invest it, so now your taxable income becomes $45,000. Okay. However, when by the time when you retire, when you're 59 years old, right? When you start taking the money out of your TSP, whatever gains out of your traditional TSP will be taxed on. That's the traditional TSP, and another one is the Roth TSP. Is that let's say if you make $50,000, right? Taxable income is $50,000, and you make, let's say you make 10% contribution to your Roth, right? So basically, you're still being taxed at $50,000 tax bracket, right? But the contribution that goes into your Roth TSP 30 years from now, when you take money out of your TSP, whatever your Roth contribution becomes, it'll be tax-free. That's the two main TSP categories, right? You have your traditional and Roth. Which one's better for you, if you ask me, right? So my opinion is that if you know your tax bracket is going to be way higher, right, than you're now. Like for example, I'm E6, my taxable income is like $50,000. 30 years from now, I am pretty sure my taxable income will be way more than $50,000 per year. So that's why I'm doing Roth TSP right now. But if you're like a Captain Admiral, right, if you're making $150,000, right, for your taxable income, I would definitely do the traditional, right, to bring down your taxable income. So that's the key takeaway for Roth and traditional TSP. There are different types of funds, right, in the TSP. So when you join the Navy after 2018, you become blended retirement system. What it means is that when you contribute 5% to your TSP, you get 5% match. If you don't contribute any, you don't get that match, right? Basically, you're throwing away like free money that the government give you, right? So a previous video I talked about, so I'm high 3, right? When I retire at 20 years, I get 50% of my base pay. But if you're a blended retirement system, you only get 40% of your base pay, right? Your retirement will be like 10% less than like whatever high 3 plan was, right? So yeah, again, highly recommend put like 5% if you're a blended retirement system just to get the match, okay? Since you join, if you never touch your TSP, you didn't have an account set up, right? Your money will be in these what we call life cycle funds, right? It's like a target date fund. TSP firm, they will invest your money for you based on your age and how much risk you can take. It's not the best, but it's still better. Before we have all the funds sitting at G funds, right? So if you don't want to learn about stocks, bonds, whatever funds, it's I mean, you can just like kind of set like a target date fund or life cycle funds, right? Just pick the year you would like to retire, and then they will adjust the percentage for you, right? Okay, so within the TSP, in addition to the life cycle funds, right, it also has like the individual funds, right? You can go to tsp.gov and then select the different funds. It will give you the explanation what this fund is and what it represents, right? Personally, my favorite fund is the C fund, right? Again, it replicates S&P 500, the 500 largest company in the United States, right? You have Apple, Google, Amazon, Microsoft, Home Depot, Starbucks, Walmart, all that. The second one, it's also the S fund, right? It's basically, it is like 1,500 companies after the top 500 companies. So I invest in C funds and S funds, so they are basically representing the top 2,000 companies. And these two funds are like I said, like it's about like 9%, 8% for the past 100 years. And yeah, so if you just do the math, it actually gives you like the projection of how much your money can grow within like a time horizon, right? 10 years, 20 years from now, like how much money, how big your TSP money will become, right? So yeah, so that's the TSP part. So TSP is a retirement account. Technically, you cannot withdraw from TSP until you turn 59 and a half. So yeah, that's kind of how the government thinks when you should retire, right? So for example, this Financial Freedom Journal, I'm shooting for like maybe age 40, 45, even maybe like 50, the latest, right? That's when I'm gonna pull the trigger and saying, hey, I'm just gonna start working and go travel, enjoy my life, right? I still have like 10 more years to go, right, before I can touch my TSP money. Yeah, so this is like when the brokerage account comes in, right? So brokerage account is that it's kind of like similar to like your retirement account, except that you can take money out of it whenever you want, right? But it doesn't come with all these like tax benefits. Whatever money you make, you'll have to pay capital gains. But like I said, when you decide to invest in the stock market, I usually like recommend leave the money in the market for at least 10 years, right? If you think you're gonna need the money under 10 years, maybe under like within 5 years, right? You may want to consider like different strategy, because like the stock market may go up, it could also come down, right? So yeah, so basically, like I said, for your brokerage account, right, you can also do the similar, like you can also just buy the S&P 500, like the C funds, right? So there's like different investment companies. They offer all the like the low cost index funds, right? Just like C funds and S funds, but just like kind of be mindful with how your tax situation is. And like I said, I'm not a professional accountant, right? So let's say when I turn 50 years old, right? I just need to calculate how much money I need to have in my brokerage account so I can withdraw the money like before I can access my TSP funds, right? So it's kind of like a bridge between your expected retire age and your actual age that you can access your retirement accounts, right? Okay, so that's the TSP and brokerage. Next one will be the IRA, individual retirement account. So the IRA is similar to TSP. Everyone that has like income can kind of like put money into your IRA, right? So let's say if you can even open a IRA account for your kids when they were born, right? So that the money inside the IRA account can basically grow, compound and grow. Yeah. So and when it comes to long-term investing, Tom is your friend. And yeah, so that's kind of like the TSP brokerage and IRA investing. If you have any questions, just leave a comment down below. I will answer your question, right? And then thank you for watching. Yeah, thanks.